Thanks, Margaret and Matthew. Please excuse me for speaking in shirt sleeves. I know from experience that it tends to get quite warm up here after a while, and that's before we get on to the Q&A. Thank you very much, Joe Mulholland, for the flattering invitation to take part in this 31st MacGill Summer School. I'm lucky enough to get to spend 2 weeks of every year in Donegal. I have done so now since 1998 or thereabouts, but this is the first time I've had the excuse to make a business visit, so I'm very pleased to be here. I'm also very pleased to discover the work of Patrick MacGill, whom I will add to my personal list of Donegal cultural seers, alongside, of course, Mr Friel, Victoria Island painters, and the great Rory Gallagher. A quick word about my background. I lead the investment strategy team at Barclays Wealth. It's a global team, and Barclays Wealth is the private banking arm of the Barclays Bank Group. We look after about £160 billion worth of client funds. We have an operation in Dublin. Actually, it's one of our fastest growing offices at the moment, and we've been able to hire people into that office over the last year or thereabouts. But realistically, I know that I'm invited not because of what I'm doing at the moment. I'm invited because of something I did 17 years ago. And with that in mind, I would ask you please to bear in mind that the views I'm about to express are very definitely, of course, my own and should not be attributed to my current employer. Now, I realise you may never want to hear a certain phrase again. A friendly economist based in Dublin once suggested that I should be boiled in my own spit. So imagine what the unfriendly economists are saying. I have, in fact, apologised many times in print, on the radio, on TV, for my unwitting cultural vandalism. In fact, I did so again this morning on RTE at about 7:45. In fact, the reality is we didn't really promote or push that phrase. It was out there on the report, but it took on a life of its own, as you know better than I do. And that's an aspect of the last 17 years or so that I have very mixed feelings about, and I will talk about that in a second. But that's the context. You'd expect me now, and I want to this afternoon, revisit the original case for the Celtic Tiger, because I think it has been overlooked. And I want again now to offer some new external perspective on where the Irish economy might be going in the years ahead. I should say that right at the beginning, the Tiger report was always explicitly an outside view. We didn't pretend to be able to comment on the detail and the local things that were going on at great length in the Irish economy at that time. That said, as an external commentator, sometimes you see things that maybe the local audience don't always spot. And I do find with any number of economies that one looks at, that sometimes the better you know an economy, the more aware you are of its blemishes. And back in 1994, in particular, local economists were focusing very much on the blemishes of the Irish economy, perhaps not looking as carefully as they might have done at the bigger picture. Now, I know, let's just get this out of the way right at the beginning, they do say that if you take all the economists in the world and lay them end to end, they still wouldn't reach a conclusion. I know that, I've got that out of the way, but I'm going to break that tradition, so I'm going to give you a conclusion, and I will give you the conclusion up front. There was substance behind the original boom here in Ireland. Growth between 1993, say, and 2000 was not driven by reckless borrowing and by house prices. The later excesses and the euphoria were very visible, and so too was, sadly, the collapse. But I've been wondering myself now for most of the last year, and some of you may have heard me say this already during the last year, whether perhaps now people in Ireland, maybe the mood in Ireland is now perhaps as excessively pessimistic as it was excessively exuberant, maybe back in 2007. The economy is slowly stabilising, and I think it can recover, and I think it can recover partly because it still enjoys and is visibly demonstrating some of the structural supply-side advantages that really underpinned the initial Celtic Tiger period, not least one of the most flexible, developed world labour markets that this economist has seen in his working lifetime. That said, in future I promise to avoid clichés like the plague. Now, going forwards, I'll speak for another maybe 15, 20 minutes. I'll break my comments into several headings. I'll go back and look a little bit more carefully at the history of the Celtic Tiger Report, what it was about, where it came from. I want to offer you a quick reckoning. Where are we now, net of the collapse as well as the boom that preceded it? And then I want to talk briefly about life after debt, whether there is some or not. So, firstly, just going back to that original report, the Celtic Tiger essay was published at the end of August 1994 as part of a Morgan Stanley report where I was working at the time that focused on the prospects actually for the Irish stock market, which had just been upgraded to developed market status by MSCI. At that time, just to show you how long ago it was, a single currency was a distant and very, very uncertain prospect on the horizon, and it was far from clear that Ireland would be included in it, even if a single currency were to come along. Now, you probably think that with the title taking off in the way that it did, we probably had a team of guys from a creative department with ponytails working into the night to come up with that exciting title. The reality was that it was down to us, and we were stuck for a title. And we almost posted a report which was titled, Ireland Growing Quickly Without Much Inflation. But even an economist, could see that that probably wasn't going to grab very much interest from the readers that we were aiming at. At the last minute, almost, the phrase Celtic Tiger sprang to mind, and nothing I have written since or will write ever again has resonated quite in that way, quite literally from Dublin, here we are, to Donegal. There was actually less to the report than you might think. It was very short, and it took a very broad brush approach, and it was designed really simply to give international investors some idea of the broad macroeconomic landscape in Ireland at that time. The most important element was that Ireland's growth story seemed to be largely a supply-side success story. Cheap credit and surging house prices were not part of the story initially, as I've already mentioned, and they seemed eventually to follow as a consequence, not as a cause, of the initial growth story. Even the well-publicized structural assistance from the European Union seemed to us in 1994 to be actually of secondary importance and seemed to be explaining only a small portion of the annual growth rates that the Irish economy then was delivering. Now, to remind you of those supply-side origins, because they have recently been forgotten or overlooked, components included a few of the following things. Firstly, the deliberate courting by the Irish authorities of foreign direct investment. Ireland very much opened itself up to investment and asked and suggested that overseas companies might want to come to Ireland to establish a base. Business taxes, as you know, were very low and very stable. Membership of the single European market and the opportunities it posed for multinational companies looking to establish a local export base into the rest of Europe also was part of the story. So too was a relatively young, educated, flexible, competitive, and very prosaically, but very importantly for a US company looking to establish a toehold in Europe, an English-speaking workforce was quite an attractive proposition too. And even at that stage, you could see the beginnings of several sectoral clusters of industrial expertise beginning to grow up, and most noticeably, as Matthew was saying, in the financial services area, but also in technology and in life sciences. By the way, in singling out these factors and giving you a reasonably positive view of at least the past, I hope I'm not just flattering this audience here today. As Margaret's pointed out, my hometown is Cardiff, and so you might say that the Celtic Tiger all along was in a sense an inside job, really. But local government there is trying currently to get that economy moving. And I was recently asked to speak at the launch of a new city centre development plan for Cardiff, and I was happy even now to offer the earlier Irish model as one which I think is worthy of attempted replication. Not all of the factors that worked for Ireland are possible to replicate in South Wales, but I do think that that initial story did have something going for it, and I think it has lessons, positive lessons, that can be learned from. Now, actually, the forecasts in the Celtic Tiger report itself were too downbeat, if anything. Growth was stronger and lasted for longer than we expected at the time. Between 1993 and 2000, GDP growth averaged 9%. For those of you familiar with finance and economics, that's the sort of growth rate that China these days is managing to turn out. The pace of growth did slow somewhat, and its character, importantly, changed after about 2000, 2001, at which stage my own career took me elsewhere, probably saving me from having to make some quite difficult calls at the time. But even between 2000 and 2007, it still averaged 5%. Predictions of imminent disaster for the Celtic tiger were commonplace throughout the 13-year period, 94 through to 2007. When the collapse did ultimately arrive, though it wasn't because the supply-side model had failed, arguably I would say it was because the supply-side model worked so well that it actually engendered overconfidence, it started to erode competitiveness, and Irish consumers tried perhaps too eagerly to try to bank too much of tomorrow's growth today. So growth became more domestically oriented. The current account of the balance of payments went into deficit, and bank lending and Georgian house prices went into orbit. Nemesis eventually followed hubris. Not that it was Ireland's hubris, Ireland's nemesis alone. The local collapse, remember, coincided with global financial trauma. The failure of Lehman Brothers and the near failure of AIG in September 2008 effectively froze the global money supply. And companies as far away as Asia, untainted by property and lending excesses, companies as far away as Asia found themselves unable to obtain working finance, and economic indicators in Asia fell as sharply, in some cases more sharply even, than some Western economic indicators. That said, Ireland's fall, of course, was dramatic, even in that global context. So that's a quick look back at the Celtic Tiger report. Let me try to offer a partial reckoning as to where we stand at the moment. Matters of good taste aside, I have to say I don't regret the original call, quite the opposite. I feel quite proud to have been able to identify and to label quite a remarkable economic transformation. I do, however, have very mixed feelings about the way in which the phrase took on a life of its own. As a descriptive term, it worked very, very well, but I do wonder whether in a very small way it perhaps fostered some of the eventual overconfidence that marked the 2001 to 2006 period in particular. Now, the relationship between the media and the markets is not often discussed or analysed explicitly, but it's very close and it's very symbiotic. We each feed off the other, and it can be economically very potent. You may remember Keynes wrote a long time ago about the phenomenon of animal spirits and how important they can be in driving economic activity. And we've certainly seen that outside of Ireland in financial markets generally of late. And I'd say that to the extent that cliches and headlines substitute for thought, perhaps they can contribute towards the extrapolative borrowing and lending decisions that fuel booms and busts, decisions that might not be made after a less colourful, lowercase debate. Perhaps, too, the Celtic temperament, if there is such a thing, renders us prone to extreme emotions. We tend easily to euphoria or to despondency. We're rarely middling, as it were. I don't have hard evidence for this, but it seems to strike a chord when I mention it to audiences, and it fits with my own casual observation at Lansdowne Road or at the Millennium Stadium. Maybe it's a case, in quotes, of passionate intensity. I think that's something that us Celts do sometimes lend themselves to. On a more serious note, after the last few years, the epistemological grounding of what passes for wider financial and economic knowledge here in inverted commas, is or should be the subject of active and intense debate. That said, that's perhaps, though, a subject for another time and space, but I do think we'll revisit that as an issue going forwards. In terms of the hard data, Ireland's real GDP has fallen by around 10% since 2007, though it's still 130%, in other words, more than twice as big, twice as large as it was in 1993, for a cumulative compound growth rate to 2010 of around 5%. On a per capita basis, it's fallen by around 13% since 2007, but it remains some 80%, 4/5 as large again, as it was in 1993. Quarterly data actually show the Irish economy to have been effectively flat, plus or minus 1%. In the wider scheme of things, this is effectively flat, since maybe middle of 2009. And gross real exports last year were actually slightly higher than they were in 2007. They were approximately equal to GDP, and as the Chiswick mentioned yesterday, they were significantly larger than GNP. What that's telling you very directly is that a significant portion of that supply side story is still out there and potentially intact. Less reassuringly, if you look at the unemployment numbers, the standardised unemployment rate is back at about 14.25%. That's levels that we last saw in 1994. It has, though, been broadly stable now for almost a year, so at least it's showing signs of flattening off. General government debt, of course, is expected to peak at a very high level at about almost 120% of GDP in 2013. That compares with a level of just 25% at the end of 2000 and only 90% even back in 1994. That said, government debt levels in Ireland have been this high in the past, I think in the late 1980s, and at around a fifth of tax receipts, the prospective interest burden on that debt now is roughly the same as it was in 1994, and actually well below its 1985 peak, which was around one-third, essentially because interest charges these days are much lower. A private sector balance sheet for Ireland is difficult to compile, but there are reasonably good data on Ireland's net overseas investment position. They show a deficit almost exactly equivalent to nominal GDP, but with its counterparts largely in government and central bank borrowing. As an approximation, then, you could say that Irish private sector borrowing essentially has been largely a domestic affair. This doesn't provide much immediate cheer for individual households or bank shareholders in negative equity, and such a thing can exist for shareholders as it can for consumers. But it means that the problem should be tractable. Put bluntly, if you collectively own the banks to whom you owe money, then in some net consolidated sense, a solution, a collective solution, must be within your collective grasp, particularly with help from a sympathetic domestic and Eurozone set of regulators. There is, of course, no right level for government or private sector debt. It's not clear that the suppressed balance sheets, for example, of the 1970s, were necessarily healthier than those in, say, 2001. The ability to borrow responsibly can be valuable. It can add to consumer well-being, simply because it adds to the amount of choice available. And think back to how things were in the 1970s. I'm not the only one in the room, I suspect, who can remember that. Is anybody really advocating today that we go back to higher purchase controls? Nor does government debt have quite the vice-like hold on the economy that many assume. The sustainability, in quotes again, that's a phrase you hear or a word you see often recently, the sustainability of public finances depends on policy decisions made by the government, it depends on market interest rates, and it depends on economic growth. And each of those has the potential to surprise positively as well as negatively. None of those things are set in stone. So on to the final section, as I said, life after debt. I've just given you a quick reckoning and a look back at the original report. Where next? Well, the continuing importance of the external sector to Ireland means that we've got to start with some global context. And you can't be constructive about the Irish economy if you think that the global economy is basically bust. And we don't. There are perhaps two extreme views of the financial crisis globally that erupted in 2008. The first is that ever since the dollar decoupled from gold in 1971, the US and the global economy has been a house of cards. On that reading, there's just too much debt. Fractional reserve banking has extended too far, and for proponents of that view, they've been telling us all along since 1971 that it would all end in tears. The opposing view suggests that maybe the global economy in 2007, with the exception of some obvious pockets of excess, for example here, in the US and UK housing markets also, but the global economy then was actually in reasonable shape, buoyed, amongst other things, by the increasing integration of the emerging world, China and India, Brazil and Russia and so forth, in global supply chains and in customer bases. And on this reading, the global economy was brought down largely by the monetary seizure that I mentioned above. And I think this latter way of looking at things is closer to reality. And it follows that having caused the near collapse of the global financial system, deregulated capital markets, and massively levered and profitable, perhaps, bank balance sheets are going to become a thing of the past. But if or when the banking system has been fixed, there's nothing to stop the global economy growing again. On this reading, the global excesses that needed to be corrected are actually smaller. They're more focused in the financial sector itself and more recent than the gold bugs would suggest. Now, the relevance of this for Ireland, of course, is that the fortunes of the local economy really are still crucially dependent on the profitability, balance sheets, and confidence of the global corporate sector. Now, on that topic, many non-financial US companies at the moment are actually finding themselves to be surprisingly profitable and remarkably liquid. They have plenty of cash. They will start to invest outside the US once again. And I would be optimistic that in the business cycle ahead, Ireland will again see a healthy inflow of foreign direct investment, because many of those supply-side attributes are still very much in place and incidentally conspicuously lacking from several of the other peripheral Eurozone countries at this particular point in time. Most obviously, if a 15% decline in the aggregate wage bill, alongside a backdrop of a cumulative fiscal consolidation equivalent to 13% of GDP, focused mostly on public spending, not taxes, if that's not a demonstration of labour market flexibility, then I don't know what is. And the erosion of competitiveness, too, has been partially reversed. Arguably, it was always overstated a little to begin with, because economists are very bad at talking about competitiveness. They tend to resort to things that they can measure, such as relative prices and costs. That's not just what competitiveness is about. But if you look at those things, they have improved as a result of that flexibility a little in the last year or so. So with this in mind, these supply-side considerations, in my view, it would surely be a mistake for Ireland now to leave the single currency, as I know some local commentators are advising. The collapse, remember, was not driven primarily by euro area monetary policies, but by domestic hubris. Even if it were possible easily to leave the single currency, the resultant interest rate and exchange rate volatility would likely cancel much of the attraction of temporarily lower costs in the eyes of many foreign firms. Participation in the single currency is part of the package that made Ireland, in the later part of the 1990s, such an attractive place in which to invest. After all, if a large US company, for example, wants to invest in an English-speaking, financially volatile, and Eurosceptic European Union base outside the euro area, there's always the UK, after all. Of course, the local banking system here is still not functioning as usual. I've got a comment here saying sighs of relief all round. But just because banks played, this is a serious point actually, because banks played a big role in the crisis, that doesn't mean that a vigorous and rapidly growing bank sector is a prerequisite for economic recovery now. For one thing, the link between financial balance sheets and the real economy is clearly a very loose one. If there was far too much credit to begin with, then perhaps you don't need as much to fuel growth from here. In the jargon, if credit was in excess supply, it's not necessarily a constraint on economic growth going forwards. After all, a shortage of loan demand or loan activity may to some extent be reflecting an absence of demand for funds. And if there is an absence of demand for funds at the moment, that's likely, obviously, to be most visible in the property and construction sectors. The bank loans that are essential to economic growth are those that provide working capital for the manufacturing and the service sectors, particularly for the smaller company sectors within those. And that sort of lending is actually a small portion of the overall bank loan book, and it ought to be forthcoming. Remember, a lot of foreign direct investment also brings with it its own source of finance. And as far as the banks are concerned, again, I'm conscious that I'm speaking alongside somebody who knows far more than I do about this, but I would say the failure of the Irish banks looks from the outside to have been at least a pretty straightforward one. Reckless property lending, a failure of what we might term utility banking, as opposed to the opaque complexities of investment banking. What that means is that the exposures are visible, they're easily disentangled, and they're mostly lodged firmly on specific balance sheets. The amounts have been daunting, but I sense that the write-downs now being seen and talked about are actually quite realistic. And coincidentally, a decline of about a half in the National House Price Index from the peak would take house prices back to levels that we last saw around about 2000, when I would date the beginnings of the end of the purely supply-driven part of the Celtic Tiger story. And for what it's worth, I think the Irish government of the day was actually right to issue that blanket deposit guarantee, which has attracted a lot of criticism. I think they were right to do so because sometimes decisive, speedy action is better than a more considered but late response. A disorderly run on bank deposits is the stuff of which anarchy is made. The government managed to avoid that. Economists in particular, we're fantastic at explaining why something that works reasonably well in practice couldn't really happen in theory, and this would be a case in point. More recently, many have been very quick to criticize the bad bank for its imperfections, but again, the government wasn't starting from scratch with time to spare. They were responding on the fly to an evolving crisis. Viewed in the international context, and considering the budgetary response alongside the monetary one, or the supervisory one, I think the Irish government actually has played its hand as well as most. And the Troika, as the Chiswick mentioned yesterday, seem to be agreeing on the budgetary front and have done so now for several iterations. Very few Western banking systems sailed through this crisis with colours flying. We have this expression, people in glass houses, remember. And at this stage, I'll just go off text very briefly. Apologies, Joe, you won't find this in my speech, but to tackle a point that somebody made this morning to do with value systems. And I'm saying here that it wasn't just the Irish financial markets that effectively did things that they weren't supposed to do. I would say globally, when you see financial variables such as the level of volatility in the United States stock market, which averaged more than 50% for 6 months, when you see interest rates fluctuate in massive ranges, when you see volatility like this, and you see markets seizing up in such a way, it makes people feel that the financial markets are arbitrary and that their hard work and considered savings and investments don't count for much. And that's the real danger of what we've lived through, because I would still subscribe to the view that free enterprise is the least bad way of arranging an economy these days. I phrase it very carefully. It's not perfect. It's the least bad way of arranging an economy. And we don't have much of a leg to stand on in arguing that after the excesses of the last few years. So it's not just in Ireland where people are questioning these values. I'm hoping we're going to come through this. The other side will realise that those excesses can be corrected and tamed. You're not alone in considering exactly what free enterprise can and should be doing as a result of all this. Meanwhile, back to Ireland, it does look as if the euro area authorities are going to continue to do their bit to prevent the Irish banking system from imploding further. And that's another reason for keeping the single currency. And I do think that those Eurozone authorities will be around to make that happen. I think last week's summit was a very clear demonstration of commitment in that respect. And I would say, excuse the borrowed cliche here, but I would say we're witnessing surely not the beginning of the end for the single currency. We're witnessing the end of the beginning, because the missing fiscal infrastructure, which we've all known, including the politicians, we've all known that that has to be part of the story, that missing fiscal infrastructure is now very, very slowly being put in place. Just coming up to the final few points. In the last resort, when talking about growth, do bear in mind that the things that drive lasting long-term prosperity, as far as economies are concerned, are not financial in nature. If a fully functioning market for credit default swaps had been an essential factor of production, then Alfred Marshall in the late 19th century would have listed it alongside land, labour and capital. He didn't, because it isn't. Debt can profoundly affect individuals, and it can affect entire economies, particularly small economies who need to borrow. In global capital markets, it can affect them for a while. But generally, at the level of society as a whole, and in the longer term, debt doesn't matter as much as some of those real underlying factors of production. And the way that you utilize them through innovation, hard work, and technological progress. Now, Ireland's endowments of real inputs didn't suddenly surge after 2001, but equally, they haven't suddenly disappeared since 2007. Now, I'm aware that this might sound all remarkably rose-tinted at the moment, so let me offer a couple of questions that perhaps even now are not asked as often as they could be, and which I do think that Ireland needs to address, many of us need to address, if, as I expect, the Irish economy stabilises and begins to grow again, thereby keeping a lid on that public sector debt. Firstly, the loss of output and jobs since 2007 has been painful. But should we acknowledge more than we do that those jobs in many cases were not sustainable to begin with? So when we draw comparisons, is it right to draw comparisons with 2007, or shouldn't we in some way look back to a more neutral starting point? Second, for every reckless lender, there is a foolhardy borrower. Where do we draw the line between free enterprise and control? Free enterprise and this feeling that Big Brother knows best. That's a tough question to answer. So in conclusion, I would hope that these comments, this brief look back, this brief look forward, I hope these comments have been useful, both in explaining, if not excusing, my earlier cultural vandalism, and maybe now in offering perhaps a slightly different perspective on the way ahead to the current local consensus. I'll finish with a point that I've made often in the last year or two. Remember that a tiger economy is a small, relatively poor country growing quickly to try to catch up with its better-off neighbours. Even after the bust, Ireland doesn't need that cliché or any others anymore. Thanks very much.